What's up, guys? Nick here, and in today's video, I'm going to be reviewing the monthly income ETF QYLD. I call it QYield, and I'll also be going over the taxes involved with it, and then I'll be showing you guys my portfolio. So let's get started. As you can see, we had another green week. I had a market gain of $434.59, and I earned $64.20 in dividends. And you can see my portfolio is finally at $46,000. I was honestly wondering if I would even make it to $45,000 with all the red days. But I'm going to show you guys my portfolio now for the week. General Mills actually up almost 8%. Apple did really well this week, as well as Altria and the utility companies. And then if we scroll down to the bottom, you can see Home Depot had a horrible week, but I've still been buying a lot of Home Depot with my weekly deposits and my dividends that I've been getting. Pfizer, Walmart, Costco, MasterCard all down. And then just from there, you have the quadfecta up a little bit. That probably means that we had RYLD that was down. But then as far as that goes, my portfolio was for the most part green, as I'm sure you guys had a pretty good week too. Now let's go over to the activity feed. And on the 21st, I deposited $125 as always every Monday. And I had 5 buys in the morning of Home Depot, Texas Instruments, Pepsi, American Waterworks, and Microsoft. All 5 companies that I love. My favorite out of these 5 being Microsoft. And all of these companies have at least a 7% dividend growth rate, which that is Pepsi at the lowest. However, Texas Instruments in the 19%. I think Home Depot also has a 19% dividend growth rate. And that's why I'm starting to buy up these stocks a lot more, is because over the next 10, 20 years, I'm going to be earning insane dividends from these stocks. And just to show you, Home Depot actually paid me $5.09 this month, which the last time I received a dividend from them, it was $3.61. And then Newsy also came up with a really good dividend of $13.58 on March 25th. So now I want to go over into reviewing QYLD, QYield. This is the Global X NASDAQ 100 cover call ETF, currently at $20.87 a share. And what I wanted to scroll down here and show you guys the dividend yield, which is currently 12.68%. However, QYLD does have a high expense ratio. And while it's not on this page, I do have it written down. It's 0.6%, which gives you a true dividend yield of 12.08%, which is a pretty high dividend yield. And it's one of the reasons we're going to be reviewing this ETF. It's one of the more popular ETFs, and it tracks the NASDAQ 100. And so let's get right into it. QYLD, these are the reasons you want to consider this stock. High income potential. QYield seeks to generate income through their covered call writing, which historically produces higher yields in periods of volatility. But it says that covered call can also limit your upside potential, which usually what that means is while you're earning higher dividends, your capital appreciation is not performing as well. And we'll do a portfolio back test in a little bit. And this is just saying that QYield has made monthly distributions for 8 years running, which is a good thing to see. 8 years is a good amount of time. However, we always want to track things based on 10 years. But looking at QYield's income over the years, I'd say it's pretty steady and safe for the most part. And this says QYLD writes call options on the NASDAQ 100, saving investors the time and potential expense of doing so themselves. And then what I want to go down into are their top holdings. As you can see, they have Apple, Microsoft, Amazon, Tesla, Nvidia, Alphabet Class C, Alphabet Class A, Meta, which is Facebook, Broadcom, and Costco. And then now I'm actually going to go over the taxes for QYLD. And right here in this highlighted section, it says GlobalX confirmed that for the year of 2021, QYLD distributions will be classified on tax documents as 100% ordinary dividends or short-term capital gains. So it says the ETF's monthly Form 19A filings estimated that the 2021 distributions to be largely ROC, but that was not the case. So what ROC means is return on capital. And usually in the past, QYLD would count their distributions as return on capital, which means that you weren't taxed on them. So that was actually pretty beneficial if you had QYLD in your taxable brokerage. Now, another one of the downfalls to the return on capital model is that it would actually lower your cost basis for QYLD. And what that means is if you ended up selling QYLD, you would have to pay more taxes because it lowered your cost basis. So now, guys, I want to get into the back test of the QYLD, and we're going to be doing an initial amount of 100 grand with dividends reinvested. We're going to do the S&P 500, the QQQ, which also tracks that NASDAQ 100. It's the growth stock, similar to QYLD's income. And then, of course, we have QYLD as asset number 3. So if we scroll down and look at this chart, it starts in December of 2013. And it should really be no shock that the QQQ performed the best from 2013 to the current month, February of 2020. The QYLD has grown up to 424K. The S&P 500 is 274K, and QYLD is 181K. With the best year for the QQQ being 48.4%, the S&P 500 being 31.22%, and QYLD being 22.67%. Now the worst year was the S&P down 8%, the QQQ down 12.83%, and QYLD down 7.49%. And if we actually look at the max drawdown, QYLD performed worse than QQQ, but better than the S&P 500. So now when we're looking at this chart, it's actually probably, well, it is more beneficial to invest your money in the S&P 500 or the QQQ than QYLD. And this is one of the main reasons that I've been putting less money into my income funds, and I've been putting it more into my high dividend growth stocks, like I showed you before: Texas Instruments, Microsoft, Costco, American Water Works, Pepsi, stocks like that. Because as you can see, you could have taken the gains from the QQQ, sold them, and even after taxes, you'd still have, I would imagine, more money than the S&P 500 if you didn't sell. And then if you wanted to, you could have invested that money into the QYLD for income. But now I want to show you guys the portfolio income. And this shouldn't be any surprise that QYLD in the orange earns more income. As you can see, in 2014, the S&P 500 earned $2,093, QQQ earned $1,662, and QYLD earned $10,583. And it dropped a little bit in the coming years, but then it shot up in 2018. And I actually want to go over here to 2021, where the S&P 500 yielded you $3,567. The QQQ brought $2,069 in a year, and QYLD brought $23,582 for the year. And I did the math, and that ends up being like a $12.28 an hour. So just imagine if you did have your money in QYLD, it's like having a more than minimum wage job in some places. Now, however, like I was saying before, you're better off investing into the QQQ or the S&P 500, especially if you are younger, because you have all those years of growth that you can gain, like I showed in the chart. If you're younger, I definitely recommend something like the S&P 500 or the QQQ so you can ride those gains over the years. However, if you're a lot older, I might actually recommend you guys going for the QQQ, NUSI, JEPI, and in the future, I'm going to be going over RYLD because as I've shown you guys in my portfolio in the quadfecta pie, I have 25% in QYLD, 25 in JEPI, 25 in NUSI, and 25 in RYLD. And like I said, I'm going to stop investing in these so I can invest in my higher growth stocks. But this pie currently earns me, if I go to my research tab, I want to say it earns me a 10% yield. Let's see. So right now it's 9.995%. So let's just say that it's 9.99% minus the 0.53 expense ratio. So this portfolio or this pie is generating me a $9.46 dividend for the year, which would be an absolute solid income for, I would say, the older investors. If you're planning to retire in less than 5 years, then I would say you probably want to go for these income stocks because you don't have that much time to really gain the growth. However, at the same time, I wouldn't just suggest throwing everything into income. I still like the diversity. Having, as you see my portfolio, I like having a lot of different stocks in a lot of different industries because it helps with diversity. It helps me to make sure that when I am earning dividend income, that it's spread out over time, and that if any one stock falls, I have 35, 34 other stocks to pick up the slack. And so guys, thank you for watching the video. If you like the video, don't be afraid to hit the like button. I think they're still giving confetti when you hit the like button. And get your $50 for free when you sign up to M1 Finance with my link. I know when I use someone's affiliate link for M1 Finance, I only receive $10. And then right now, you can also get 5 free stocks when you sign up to Webull with my link.